Hey, it's Darius, and Black Friday is on at i75cmareview.com. So if you're studying to become a certified management accountant, click Get It Now, and for just $2.99, you get both parts 1 and 2 for 24 months. Just $2.99. When are you ever going to see a price like that? Only on Black Friday, and only at I-75, where the right teacher makes all the difference.
We already know a little about finance leases, but what else do we need to know? On the balance sheet, it's similar to operating lease rules, which means at lease inception, the lessee records a right of use asset and a lease liability. The amount of lease liability recorded by the lessee is the present value of the lease payments. The present value computation itself requires the use of an appropriate interest rate, and the interest rate used in the present value calculation is the lessee's incremental borrowing rate unless the lessor's implicit rate is known to the lessee. Then the lessee uses the lessor's implicit rate instead of their own incremental rate. Under finance lease rules, though, the interest expense is not just calculated, but also recognized as a separate expense, along with amortization expense of the right of use asset. And this is the same amortization schedule we looked at in the operating lease video, where we said that the implicit interest rate, in this case 10%, is the math rate built into the payments by the lessor. And if the lessee knows the implicit rate, if they know the rate used to build this table, then the lessee uses the implicit rate instead of the incremental rate. But the interest expense is going to be recognized now because we're using finance lease rules instead of operating lease rules. And why are we using finance lease rules? Because it must have met one of the 5 criteria. Finance lease criteria, one more time. Of course, the lease would have to be greater than 1 year. If it has a transfer of title and the lessee becomes the owner after making the last lease payment, that would automatically qualify as a finance lease. If it doesn't have that, but it has a bargain purchase option, that would automatically qualify the lease to be a finance lease. Not just a purchase option, but a purchase option that the lessee is reasonably expected to take advantage of after making the last payment. If it doesn't meet either of these two tests, but 75% of the useful life is being leased out, then it's automatically a finance lease. So if it's a 3-year lease and they tell you the asset's supposed to last 4 years, that meets the 75% use test. But if it's only a 2-year lease of a 4-year asset, then that would not meet the criteria. And remember, you only have to meet one of these 5 criteria for the lease to be a finance lease. And criteria 4 could be met where the present value of the lease payments are 90% or more of the fair value of the asset at lease inception. And that just means that the lessee is going to pay so much for this asset compared to its fair value that you might as well just make it a finance lease. And if it doesn't meet any of these 4 criteria, but there's number 5 here, if the asset has no alternative use to the lessor, it's automatically a finance lease to the lessee. So let's try this question. Which of the following conditions would classify a lease as a finance lease? A, ownership does not transfer to the lessee at the end of the lease term. Well, that's evidence of an operating lease. B, the lease contains a clause that requires the lessee to insure the asset. I would expect that any lease would have that clause, regardless of whether it was a finance lease or an operating lease or even a short-term lease. You would think that there would be a clause that says that the lessee would have to insure the asset. So B is out. It's certainly not one of the 5 criteria for a finance lease. C, the leased asset is not of a specialized nature and has many alternative uses. That's wrong because for it to automatically be considered a finance lease, it would have to have no alternative uses. So having many alternative uses is more evidence that it's an operating lease. So it must be D. The lease contains a bargain purchase option that the lessee is likely to take advantage of. Letter D is correct. A bargain purchase option is a clause in a lease that allows the lessee to purchase the leased asset at a price significantly below its expected fair value at the date the option becomes exercisable, which is usually after the last payment. If the lessee is likely or reasonably certain to exercise this option, it indicates that the lease is effectively a purchase of the asset over time, which is one of the criteria for classifying the lease as a finance lease. We need to talk about a guaranteed residual value because in lessee accounting, a guaranteed residual value refers to an assurance provided by the lessee to the lessor that the value of the leased asset at the end of the lease term will be at least a specified amount. And this comes into play when the lessee has to return the asset at the end of the lease, and the lessor is looking to either sell the asset to someone or maybe lease it again to someone else. So when a residual value is guaranteed by the lessee, it means the lessee ensures that the lessor will receive at least this guaranteed amount at the end of the lease term, even if covering the shortfall in cash. So when accounting for a finance lease, the lessee must include the present value of any guaranteed residual value in the initial measurement of the right of use asset and lease liability. And this means that the lessee is recognizing an obligation to either return the asset with a value equal to the guaranteed residual value or make an additional payment to cover the difference. And you can see guaranteed residual value in an operating lease question also, but they're more likely to ask it in a finance lease question. And if you get a question on it, it'll probably look like this. They want to know how much is the present value of the lease payments at lease inception. So we're going to be multiplying times the present value factor again, but there's 2 present value factors given. In fact, there's even 3. So on January 1st, year 1, Trinity Inc. leased equipment. The lease requires Trinity to make 5 annual payments of $13,000 beginning December 31st, year 1, beginning a year from now. So this is an ordinary annuity, not an annuity due. So right away we can cross out the annuity due factor of 4.24. Not going to need it. We're going to need the ordinary annuity factor, 5 payments at 3.89. They tell us insurance was paid up front for the year at a cost of $800. We'll expense that. Don't include that as the part of the present value of the lease payment. There's a guaranteed residual value, though, of $6,000, and the asset is expected to be worth only $1,000 at the end of the lease term. So that means Trinity is guaranteeing $5,000 more because it's expected to be worth $1,000, and they've got to return it with a value of at least $6,000. The lease qualifies as a finance lease. The interest rate used, 9%. They give us the present value factors. First, we'll take a look at the 3.89 and multiply that by the lease payments of $13,000 because this is an annuity. This is 5 payments. Annuity means same payment every time. There's going to be 5 of those. So multiply 3.89 times 13,000. And if there was no guaranteed residual, the answer would be letter D, 50,570. Remember, we use the ordinary annuity, 3.89, not the 4.2, because there's no immediate first payment. So it's not an annuity due factor, it's an ordinary annuity factor. If the first payment was January 1st, year 1, then we would have used the 4.24. So we'll ignore 4.24, don't use that. Use the 3.89, multiply it by the payments of $13,000, and that's where we got $50,570. And we said if there was no guaranteed residual, the answer would be letter D. But because of the guaranteed residual value, we have to take the $5,000 difference and multiply it by the present value of one payment 5 periods from now. We might have to come up with $5,000 5 periods from now. Multiply by 0.65 and you get $3,250. That's the present value of the guaranteed residual. Add the 2 amounts together and the present value of the lease payments at lease inception is letter A, $53,820. The journal entry on day 1 would be to debit the right of use asset, credit the lease liability for $53,820. And then if you remember, there was that $800 of insurance they told us about. That would be expensed on day 1, debit insurance expense, credit cash. All right, same facts. They want to know how much is the interest expense recorded on December 31st, year 1. So we carried a lease liability balance of $53,820 all year from January 1st right to the end of the year. So we'll multiply that times 9%, and the interest expense is $4,843, which is letter C. Notice that under finance lease rules, we separately recognize that interest expense. There it is in the journal entry. We debit interest expense. We're also going to credit cash for the amount of the payment, and then we'll plug the lease liability for the difference of $81.57. Notice that we're reducing the lease liability on 12/31 by the amount of the payment that doesn't represent interest. Very similar to what we did on operating lease rules when there's no immediate first payment. Okay, now they want to know about the amortization of the right of use asset. So it's the same facts, but they added one new thing. Assuming a 7-year life and a 5-year lease term, how much is the amortization expense of the right of use asset on December 31st, year 1? Are we going to amortize this right of use asset over 5 years or 7 years? Let's go back to our finance lease criteria. Remember the first two criteria? If there's a transfer of title or a bargain purchase option, that's when I want you to amortize the right of use asset over its estimated useful life, which would have been the 7 years. But if there's no transfer of title or bargain purchase option, then amortize the right of use asset over the shorter of its estimated useful life or the lease life. In this case, 7 years versus 5 years, which one's shorter? The lease life of 5 years. So back to the question now. They want to know how much is the amortization expense of the right of use asset on December 31st, year one. We know that the right of use asset started at $53,820. Divide by the 5 years, the shorter of the lease life or the useful life of the asset, and you get $10,764, which is answer choice B. The general rule for amortization of the right of use asset is to use the shorter of the lease life, 5 years, or the asset life, 7 years, unless there's a transfer of title or a bargain purchase option. Doesn't say that there is in the facts. There's no bargain purchase option. In fact, there's the opposite of a bargain purchase option. There's a guaranteed residual value. Instead of the lessee likely taking advantage of a bargain purchase option, no such thing here. There's a guaranteed residual value. The lessee has to guarantee that this asset's going to be worth $6,000 at the end of the lease term, and it's only expected to be worth $1,000, and that's why we multiplied $5,000 times the present value of one payment, 0.65, when we determined the lease liability and right of use asset in the prior question. So remember, when we amortize the right of use asset, the general rule is use the shorter of lease life or asset life unless there's a transfer of title in the facts or a bargain purchase option, and then you would use the 7 years, the asset life. So we said a guaranteed residual could be in a finance lease, could be in an operating lease, but a bargain purchase option will only be in a finance lease. It allows the lessee to purchase the leased asset at the end of the lease term for a price that is significantly lower than the expected fair value at the time the option can be exercised, which is usually after the last payment. The price is considered low enough that at inception of the lease, it's reasonably certain that the lessee will exercise the option, and when initially measuring the lease liability and right of use asset, we said the lessee must include the present value of the payments required under the lease, including any payments for the bargain purchase option. So treat the bargain purchase option the same way we treated the guaranteed residual. Multiply it times the present value of one payment and add it to what you already calculated when you use the annuity factor. When the lease contains a bargain purchase option, remember to amortize the right of use asset using the useful life of the asset, not the shorter of the two. And keep in mind that the same lease cannot have both a bargain purchase option and a guaranteed residual, but it could have one or the other. See, if it had a bargain purchase option, that would be very good for the lessee, but not good for the lessor. On the other hand, if the lease had a guaranteed residual value, that would be excellent for the lessor, not good at all for the lessee.
All right, let's try this question. January 1st, year one, Zenith Inc. enters into a finance lease for equipment with a fair value of $101,000. The lease term is 5 years, and the lease includes a bargain purchase option to buy the equipment for $10,000 at the end of the lease term. The lease requires annual payments, $22,000, payable when? At the end of each year. The interest rate implicit in the lease, 6%, and that's known to both parties. The present value of an ordinary annuity for 5 years at 6%, 4.2124. The present value of a dollar due in 5 years at 6%, 0.7473. How much is the lease liability on January 1st, year one? And the answer is C, $100,146. We have to do two calculations to determine the present value of the lease liability. First, the present value of the annual lease payments. Each lease payment is $22,000, and it's made at the end of each year. Right now we're at the beginning of the year, and since the first payment is not due now, then we don't use annuity due factor. We use the ordinary annuity factor, which is given at 4.2124. So just multiply 4.2124 times 22,000, and we get 92,673. But before we choose letter A, remember there's a bargain purchase option in this lease. So we have to discount the bargain purchase option back to present value. They tell us there's a bargain purchase option to buy the equipment for $10,000 at the end of the lease term. What's that worth today? They give us a factor of 0.7473,
which represents 5 periods from now at 6%. We multiply 10,000, one-time payment, times 0.7473, and we get 7473. We add the two present value calculations together, and we get 100,146. And that means both the right of use asset and the lease liability will be recorded today on January 1st, year 1 for 100,146. Letter C is correct. All right, same facts now. What do we want to know? How much interest expense will appear on Zenith Corp's income statement December 31st, year 1 as a result of this finance lease? And don't pick A0 because we're going to have to recognize interest expense since this is a finance lease. It's not like an operating lease where we calculate the interest but we don't recognize it separately. For a finance lease, we calculate the interest and we recognize interest expense on the income statement. So the interest expense, $6,009. How do we get it? It's based on the initial lease liability of $100,146 that we calculated in the previous question, times the 6% implicit rate that they told us about, equals $6,009. So on the income statement, interest expense is $6,009. On the balance sheet, cash is reduced by the $22,000 payment, and the difference between $22,000 and $6,009 is $15,991. And what do we do with that? That's a reduction of the lease liability. And they could ask you on the exam, how much is the lease liability after the first payment? And the answer would be the initial lease liability minus the reduction of principal equals $84,155. And what do you think we're going to do with that $84,155? We're going to base year 2 interest expense on this $84,155. So if they asked us for interest expense year 2, it would be $84,155 times the 6%. But this question asks for interest expense for December 31st, year 1, and the answer is $6,009 based on the initial lease liability. All right, similar facts, but now they want to know if the asset has an 8-year remaining useful life at the inception of the 5-year lease, how much amortization expense is recognized on the income statement at 12/31 year 1 for the right of use asset?
And if you think you know, leave me the answer in the comments or community section. And if you found this video from I-75CMA helpful and you want to see the end of it and more videos like it, go to I-75CMAreview.com and get yourself on the right road to passing Part 1 and Part 2. We always have a great special, but if you're fortunate enough to get the Black Friday special, you get Parts 1 and 2 of I-75CMA for 24 months for just $2.99. That's the lowest prices of the year, lowest price ever. So go to I-75CMAreview.com and get yourself on the right road. Get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a link in the description.